Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate filings so you don't have to. Today we are diving into a filing that seems to involve some serious defense contracts and maybe a little bit of self-dealing. Sounds like a fun combination, right? We're looking at a report from Nuburu, a company that, according to this document, just made some interesting moves involving acquiring technology and interests in other companies. The key takeaway, Nuburu is looking to expand its business, especially in the defense sector through some acquisitions and licensing deals. But there are a few red flags we need to unpack, especially concerning potential conflicts of interest. The report kicks off by saying that in February, Nuburu entered into an agreement, a commitment letter actually, with Trumar Capital. This agreement is all about Nuburu potentially acquiring three things. First, a license for some technology to boost its defense business. Second, a controlling interest, meaning more than half ownership in a defense tech company that makes vehicles and electronic devices for defense. Third, a controlling interest in a software as a service startup that focuses on operational resilience. Basically, software that helps businesses adapt and recover from disruptions. The defense tech company seems pretty interesting. They design and build different kinds of vehicles, not just your everyday cars, but also things used in industrial and military settings. Plus, they also make electronic devices for defense and security, advanced telecommunications, and tracking systems. So they are involved in some pretty high-tech stuff. Here is where things get a little complicated and potentially problematic. The report mentions that Nuburu's executive chairperson, essentially the head of the company's board, owns a controlling interest in the SaaS startup they're looking to acquire. This is what we call a conflict of interest because the chairperson might benefit personally from the deal, which could influence their decisions in a way that isn't necessarily best for the company and its shareholders. To address this, the report says that the independent board members will negotiate the investment and it will need stockholder approval. This means the people who own shares in the company get to vote on whether or not to go through with the deal. This is supposed to protect the company from any unfair deals. The investments are planned to happen in stages. The first stage involves licensing the technology from the defense tech target and buying a 20% stake, meaning a fifth of the company. The price tag for this first stage is $1.5 million in cash plus $23.5 million in notes, which are basically IOUs. These notes have a 5-year maturity, meaning they need to be paid back within 5 years, a 10% annual interest rate, which is the cost of borrowing the money, and a 3-month grace period before starting monthly payments. The second stage, which needs the thumbs up from stockholders, is about investing more to get a controlling interest in both the defense tech company and the SaaS startup. If this happens, Nuburu would also get the right to appoint directors to the boards of these companies based on how much of each company they own. This means they would have a say in how these companies are run. The commitment letter is not a done deal yet. It depends on a few things. First, Nuburu needs to do its homework, called due diligence, to make sure everything checks out with the companies they are looking to invest in. Second, they need to get regulatory approval, which means the government needs to sign off on the deal. And third, as we mentioned, the stockholders need to give their consent. The final investment agreements are expected to include standard stuff like promises, guarantees, and conditions that need to be met before the deal can close, as well as the right to back out of the deal if things go wrong. This part is basically a warning to investors. It says that this report isn't an offer to sell or buy securities. It also urges stockholders to read the proxy statement and other documents that will be filed with the SEC because they will have important information about the proposed transaction. A proxy statement is a document that gives stockholders the information they need to make an informed decision when voting on company matters. Basically, do your research before you vote or invest. This section is about who might be trying to convince stockholders to vote a certain way on the proposed transaction. It says that the company's directors and executive officers could be considered participants in this effort. The report also mentions that information about their interests in the transaction and their ownership of the company's securities can be found in the company's filings with the SEC. Again, more information for investors to check out. This is the standard forward-looking statements disclaimer. It basically says that the company is making predictions about the future, but those predictions might not come true. These statements are based on estimates and assumptions that are subject to risks and uncertainties. A bunch of factors could cause actual results to be different from what the company expects. The company points out some specific risks, like the ability to meet security exchange listing standards, the impact of a previously announced foreclosure process, failure to achieve expectations regarding business development and acquisition strategy, the inability to access sufficient capital to operate, and the inability to recognize the anticipated benefits of the current transaction. General economic, business, and competitive factors, as well as volatility in the financial system and markets, are also mentioned as potential risks. Now, what does this all mean? Nuburu is trying to make some big moves to expand its business, particularly in the defense sector. This could be a good thing for the company if it works out. More money is always good for business, right? However, there are some serious risks to consider. The biggest red flag is the potential conflict of interest, with the executive chairperson owning a controlling interest in one of the companies they are looking to acquire. This raises questions about whether the deal is really in the best interest of the company and its stockholders. The company is currently in a tight spot, and this type of high-risk move to acquire a company could be exactly what Nuburu needs to kickstart its business and increase its profitability. It would probably take a lot of time and effort, but might be well worth it. Looking at Nuburu's overall direction, it seems like they are trying to pivot towards the defense sector, which could be a smart move given the current geopolitical climate. However, they need to be careful about managing these acquisitions and making sure they don't overextend themselves financially. The reliance on debt, as evidenced by the $23.5 million in notes, is also something to watch out for. From a stock price perspective, it's tough to give a precise target without more financial information and a clearer picture of the company's overall financial health. It seems like a binary situation. It could either drop to bankruptcy or climb to great heights. In conclusion, I'm leaning towards bearish on Nuburu right now. The risks seem to outweigh the potential rewards, especially given the conflict of interest and the company's existing financial challenges. But if you believe in the company's vision and are willing to take on significant risk, it might be worth keeping an eye on. Thanks for watching. If you found this analysis helpful, please subscribe to Corporate Decoder for more deep dives into corporate filings.